I have been thinking a lot about the changing global landscape, and I'm ready to share my thoughts. So Iran just closed the Strait of Hormuz, and gold and silver went down, not up, down. The world's most powerful geopolitical shock since 1973 landed 2 weeks ago. Oil tankers are being blown up in the Persian Gulf right now on this day, March 13th. And gold, which was at $5,119 when the bombs fell, is trading at $5,085 today. Silver, which touched $96 in the chaos of March 2nd, is sitting at $82. Most investors see that and think the crisis is over. Ray Dalio sees it and says the real move hasn't even started yet. But the real story isn't that gold went down while a war is happening. The real story is why and what every single investor who owns gold, silver, stocks, or a retirement account needs to understand before the mechanism that is suppressing these prices right now reverses, because it will reverse. And when it does, the move will be faster and larger than anything you saw in the spike of early March. Ray Dalio's private assessment of what is happening to gold and silver prices on March 13, 2026, is the most precise diagnosis of precious metals market mechanics he has issued in 40 years of managing capital across every geopolitical and monetary crisis in modern history. What he said about why gold falls first in a war and what always happens next is something every gold holder, every silver holder, and every investor sitting in a 401k needs to hear before this window closes. Subscribe now. Here's exactly what is happening and why most investors are reading it exactly backwards. At 3 a.m. Eastern Time on March 2, 2026, Operation Epic Fury began. U.S. and Israeli strikes hit Iran. Supreme Leader Khamenei was killed. And within minutes of the first reports reaching trading desks in London, gold surged to $5,219 per ounce, its highest level since January 30th. Silver touched $96.40. Oil spiked 13% to $80 per barrel before markets even opened. Retail investors saw those numbers and did exactly what every financial media outlet told them to do. They bought gold at $5,400, silver at $95, defense stocks at their peak, oil companies at the top of the spike, and then something happened that nobody on CNBC explained clearly. Gold fell, silver fell back hard, dropping as much as 7% intraday from $96 to the high 87s. And as of this morning, March 13th, gold is at $5,085 per ounce. And silver has fallen to $82.34, both lower than before the war began. The investors who bought the spike are underwater. The investors who waited are confused. And the financial press, which spent 2 weeks publishing headlines about $6,500 gold and $150 silver, is now running articles asking why the metals aren't responding. Let me say what is actually happening, because Ray Dalio has seen this exact sequence before, not once, every single time. Here's where things get important. The number you need to understand is not 5,085. The number you need to understand is 0.4. That is how much the 10-year U.S. Treasury yield rose from a 4-month low on the morning of March 2nd, when gold was simultaneously spiking to $5,419. Let me say that more precisely because most investors have never been taught this relationship. The 10-year Treasury yield rose 0.4% from a 4-month low as higher energy prices would make the Federal Reserve less inclined to cut interest rates. At the exact same moment gold spiked on fear, bond yields rose on inflation expectations. And rising bond yields are the single most powerful mechanical suppressor of gold and silver prices in the modern financial system. Not a rounding error, not a coincidence, not a minor footnote in precious metals mechanics. The war that was supposed to send gold to $6,500 simultaneously created the exact monetary condition: rising inflation expectations, rising bond yields, rising dollar that suppresses gold and silver prices in the short term. Precious metals continue to trade largely inversely to oil prices, as rising oil prices are boosting the U.S. dollar index on safe haven demand. Oil up, gold down. That is the mechanical sequence that has played out since March 2nd. And it is the sequence that every retail investor who bought the gold spike failed to understand before they bought it. And this is where the real story begins. Because Ray Dalio doesn't see a gold price when he looks at March 13th, he sees a setup. He sees the exact configuration that preceded the largest precious metals rally in recorded history. Not the 2 spike, the 7-year move. The one that turned $10,000 into $243,000. The one that started not at the moment of maximum fear, but at the moment when maximum fear gave way to the realization that the inflation it created was permanent. Go back to 1973. The OPEC embargo hit in October. Oil quadrupled from $3 to $12. And gold, what did gold do immediately? It spiked, then it pulled back, then it traded sideways while oil stayed elevated and inflation built into the system. And then when investors had concluded that gold had failed to perform, when the retail money had moved on to other stories, the real move began. During the Iranian Revolution from 1979 to 1980, crude oil surged over 110% while gold climbed nearly 150%, making its biggest two-year percentage gain on record. By 1980, gold had risen 2,300% from its 1971 price. Not from the moment of the shock. From the moment the shock proved to be structural, embedded in the monetary system, impossible for central banks to fight without destroying the economy. That is the pattern Ray Dalio is watching right now. And the setup is more structurally powerful in March 2026 than it was in October 1973. 3 layers. Layer 1, the oil shock is not temporary. Oil prices are expected to remain high until a concrete positive solution to open the Strait of Hormuz emerges. There is no concrete positive solution in sight. Iran's Revolutionary Guard has shut down the Strait of Hormuz, the world's most vital oil export route through which 20% of the world's oil consumption passes. With 100-plus tankers halted and 2 ships already attacked, the disruption is real and immediate. Wood Mackenzie warns of $100 oil if the closure persists. Goldman Sachs has calculated an $18 per barrel real-time risk premium already priced in. Every week the Strait remains commercially disrupted is another week of elevated energy costs feeding into core inflation. The inflation that keeps bond yields high keeps the Fed trapped and keeps the short-term gold suppression mechanism running until it doesn't. Layer 2, the suppression mechanism has a finite lifespan. Rising bond yields suppress gold only as long as the market believes the Federal Reserve will respond to inflation by keeping rates high. But the United States is rolling over $9.22 trillion in federal debt this fiscal year at rates between 4% and 5%. Annual interest payments have crossed $1 trillion, more than the defense budget. The arithmetic of sustained high rates against a $36.2 trillion debt load is not indefinitely sustainable. The moment the bond market concludes that the Fed will be forced to choose between fighting inflation and servicing the national debt, the moment yields stop rising and start falling despite elevated oil prices, the suppression mechanism reverses. And when it reverses hard because gold will then be responding to both the inflation that the oil shock created and the monetary response that the debt level forced. That combination is the 1979 scenario, and J.P. Morgan has already published the target for what that combination produces. $6,300 per ounce by end 2026, with Deutsche Bank standing by a $6,000 year-end target. Layer 3, the silver divergence, the setup nobody is covering. Silver exploded briefly to 96.40 cents on March 2nd, then crashed as much as 7% intraday to the high 87. Silver is half investment metal, half industrial metal. War fears boost the investment side, but oil shocks and stock sell-offs raise recession worries, which hurt industrial demand. That's why silver swings harder than gold. Silver at $82 today against a January high of $113 and a March 2nd spike of $96 is not a broken bull market. It is a retest of support in a commodity that has been in structural supply deficit for 6 consecutive years, that has COMEX registered inventory down 64% from its 2020 peak, and that has China restricting silver exports as a strategic resource. The retest of the $72 support in February triggered a strong rebound which suggests that silver will likely continue to surge towards the record level of $120. The formation of the cup and handle pattern in the last quarter of 2025 has initiated a strong surge. Silver price forecasts suggest breaking $120 in 2026 and moving towards $150. The retail investor who sold silver at $82 because it didn't perform during the war has confused a pullback within a structural bull market for the end of the thesis. The structural thesis, 6-year supply deficit, COMEX drainage, China export controls, industrial demand from solar, EVs, AI, and defense has not changed. The price has. Those two things are different. Ray Dalio has spent 40 years watching investors make the same mistake in every precious metals cycle. They buy the emotional spike. They sell the structural pullback, and then they watch the structural move, the one that was always coming from the sidelines. His framework is precise. The short-term price of gold and silver in a geopolitical shock is determined by 3 mechanical factors: the dollar's response to oil, bond yields' response to inflation expectations, and speculative positioning that gets unwound when the initial fear subsides. All 3 of those factors suppressed gold from $5,419 to $585 in 2 weeks. None of those factors change the structural reality: an energy shock that is embedding higher inflation into the system, a monetary authority that cannot raise rates aggressively against a $36.2 trillion debt, and a global creditor community that has been systematically shifting reserves from dollars into gold for 3 consecutive years at above historical tonnage. Dalio put it this way in his framework on precious metal cycles in monetary history. In 40 years of managing capital across every geopolitical and monetary crisis in the modern era, I have found one consistent truth about gold. The short-term price and the structural price are almost always different things. The short-term price is set by the dollar, by bond yields, by speculative positioning, by the mechanical relationship between oil and currency that every trading desk understands and exploits. The structural price is set by the debt cycle, by the credibility of the monetary system, by the accumulated weight of central bank purchasing decisions made over years and decades. The investors who buy gold at the emotional spike and sell it at the pullback are trading the short-term price. The investors who understand the JP Morgan $6,300 target, Deutsche Bank's $6,000 target, and 863 tons of central bank gold purchases in 2025 alone represent the structural price. Those investors do not sell at $5.85. They recognize it as the accumulation window that the short-term volatility has just opened. He continued, "The 1973 parallel that everyone is drawing is correct in its conclusion, but wrong in its timing. Gold did not go to 2,300% in 1973. It went to 2,300% over the 9 years following 1971 with the oil shock of 1973 as the first structural catalyst and the second oil shock of 1979 as the accelerating event. The investors who bought in 1973 and held through the volatility, through the pullbacks, through the periods when everyone said the crisis was over and gold had failed to perform, those investors captured the full move. The investors who bought at the 1973 spike and sold when it pulled back missed the 2,300%. They were right about the direction. They were wrong about the time frame. The same mistake is being made today on March 13, 2026 by every investor looking at gold at 5,085 hours and concluding that it should have gone higher if the thesis was right. He closed with this. In 40 years, the signal I watch after a geopolitical shock is not whether gold performed in the first 2 weeks. Gold always underperforms in the first 2 weeks when oil is simultaneously driving the dollar higher and bond yields upward. The signal I watch is whether the structural conditions that preceded the shock, the debt levels, the central bank purchasing behavior, the supply deficits in physical markets have changed. In March 2026, those structural conditions have not changed. They have intensified. The oil shock has added an inflation layer on top of a debt layer that was already the largest in peacetime history. The suppression mechanism is running. It will run until it can't. And in 40 years, I have never seen the structural conditions that exist today fail to eventually produce the structural outcome they imply. The question is not whether, the question is when. And the investors who understand the difference between those two questions are the ones who do not sell at 5,085. The market scorecard for March 13th confirms exactly what Dalio's framework predicts. Gold at $5,085 per ounce, silver at 82.34, both lower than before the Iran war began, with the suppression mechanism operating exactly as the bond yield and dollar relationship predicts. The gold-silver ratio has compressed to near 57, meaning gold is 57 times the price of silver. Historically, when this ratio moves toward its extreme and then snaps back, silver outperforms gold by 3 to 5 times on the reversal. The gold-silver ratio compressed to near 57, a sign that silver can lead in strong bull phases. Gold has now made 17 one-day moves of more than $100 per ounce in the first 9 weeks of 2026. Prior to this year, gold had only ever made 14 such moves in its entire recorded history. The volatility is not random. It is the symptom of a market in which the short-term mechanical price and the structural price are separated by the widest gap in 40 years, and in which the resolution of that gap when it comes arrives in violent, concentrated moves rather than gradual trends. JP Morgan predicts $6,300 per ounce by end of 2026. Deutsche Bank is standing by a $6,000 year-end target. Neither institution is issuing those targets based on the short-term dollar oil yield mechanics that are suppressing gold today. They are issuing them based on the structural conditions that those mechanics cannot suppress indefinitely. Oil remains above $85. The Strait of Hormuz remains commercially disrupted. The Federal Reserve meets on March 18th and 19th with traders pricing virtually zero probability of a rate cut because the oil shock has made cutting rates into a live inflation spiral and active risk. The debt service clock on $9.2 trillion in maturing U.S. Treasuries is running. And central banks, which bought 863 tons of gold in 2025, have not slowed their purchasing despite prices already above $5,000. One type of investor read the gold spike on March 2nd and saw a trade. They bought at 5,219. They watched it fall to 585. They concluded the thesis was wrong. They sold. The other type of investor reads March 13th as Ray Dalio reads it, not as evidence that gold failed to perform, but as the accumulation window that the short-term suppression mechanism has created inside a structural bull market that has not changed direction, has not changed its fundamental supply-demand dynamics, and has not changed the debt cycle reality that JP Morgan, Deutsche Bank, and 76% of global central bank reserve managers have already concluded will drive gold to $6,000 to $6,500 before this cycle ends. This was not a gold price story. It was not a silver price story. It was a story about the difference between the short-term price and the structural price. and the window that opens between them every time a geopolitical shock temporarily suppresses an asset whose structural bull case has not changed. The window is open right now at $5,085 gold and $82 silver on March 13, 2026, while tankers burn in the Strait of Hormuz and the Federal Reserve prepares to hold rates in 6 days, and the U.S. Treasury prepares to roll over its next tranche of the $9.2 trillion refinancing wave. The 1973 investors who held through the pullback turned $10,000 into $243,000 over 9 years. The question Ray Dalio is asking, and the question every gold holder, silver holder, and retirement account owner should be asking today, is not whether gold went up enough after the Iran war. The question is whether the structural conditions that drove the 1973 to 1980 move are present in March 2026. Every data point says yes. Every institutional target says yes. Every central bank purchasing report says yes. The move that most investors are waiting for confirmation of has already been confirmed by JP Morgan, by Deutsche Bank, by 863 tons of annual central bank buying, by the structural supply deficit that has run for 6 consecutive years in silver. The confirmation was published while everyone was watching the short-term price fall. Most investors have no idea what's coming. Now you do.